Hey everyone! While Robert takes a short break from the studio, we've put together some of our favorite moments from this year's Rich Dad radio show. We hope you enjoy the highlights.
Hello. Robert Kiyosaki, Rich Dad radio show, broadcasting from Arizona. And today we have a very special, one of my original guests, 25 years ago, I believe now. And Richard Duncan, and we're so old. I found his book in Borders bookstore, which is now gone, out of business by Amazon. I mean, so much has transpired because things are moving so quickly. What is going to happen, Richard? How serious? Because you wrote the book, The Dollar Crisis. Can it be a much bigger crisis than this?
Right. So I wrote The Dollar Crisis in 2002. And that's the one that you saw, and that's how we got to know each other.
Yeah.
And in the dollar crisis, I was very worried about these very large U.S. trade deficits that were destabilizing the global economy. They were blowing the trade surplus countries into bubbles like Japan and later on China. And the money was boomeranging back in the United States and blowing the U.S. into a bubble. And I said, this bubble in the U.S. is going to pop. And it's going to lead to a financial sector crisis and a severe recession, and probably a collapse of the dollar standard in the global and the dollar reserve currency status. Well, so that collapse actually did happen in 2008, and the financial sector almost did collapse. There was a very severe recession, but the government managed to reflate the bubble with trillions of dollars of paper money creation and trillions of dollars of budget deficits. So the Great Depression that I foresaw at that time didn't happen. I just jotted down how things have changed since then, 22 years ago. At that time, the trade deficit was $450 billion in 2002. Last year, it was more than twice that much, $1.1 trillion. And the cumulative deficit, if you add them up over the years, in 2002, the cumulative deficit was $3 trillion. Now it's $16 trillion. In 2022, the U.S. government, the total debt in the U.S. was $33 trillion. Now it's $100 trillion, so 3 times larger. The government's debt in 2002 was $6 trillion. Now it's $36 trillion, 6 times larger. The total assets of the Fed, how much money they created back then, that was $700 billion. It peaked a couple of years ago at $9 trillion. Wealth in the United States in 2002 was $46 trillion. Now it's $169 trillion. And China's economy in 2002, it was $1.5 trillion. Now it's $18 trillion. Gold was $300. Now it's $3,500. So my point is that by keeping this bubble inflated in 2008 and again in 2020, it's made this global bubble so much larger than it was when I first wrote The Dollar Crisis in 2002. Now I think we're so much more vulnerable than we were then, and it's going to be so much more difficult to keep this bubble inflated. And so I think we're now moving into I've just published a new Macro Watch video today called The Dollar Crisis 2025. I think we're moving into this new period where the dollar is going to plunge like it did after 2002. Between 2002 and 2008, the dollar fell 41%, and that had seriously destabilizing consequences for our trading partners, for the global economy, for the U.S. financial markets, and ultimately the global financial crisis blew up entirely in 2008. So now we're in this situation where we have a much bigger bubble and much less firepower to try to combat it if the bubble pops. So now we're turning to your question about what's going to happen if other countries start dumping our treasury bonds. This is a real concern. And so President Trump, as you know, has put up very high tariffs on all the countries in the world, but especially on China, 145% tariffs on China. And he has a plan. There is a strategy. This strategy was laid out in a paper by a person called Stephen Moran, who is the chairman of the Council of the President's Economic Advisors. And here's Moran's three-step plan. Step one is to put very high tariffs on all the countries of the world. Step two is then to threaten all of the other countries in the world to remove the United States security umbrella from them if they dare to retaliate against the high U.S. tariffs. And step three is then to force all of these countries to devalue the dollar.
Hello, Robert Kiyosaki, the Rich Dad Radio Show. Again, broadcasting from Phoenix, Arizona, where it's either heaven or hell. And right now, it's heaven. In a few more months, it'll be hell. But anyway, we have a very special guest today, and for full disclosure, I don't know him. His name is Chris Whalen. Welcome to the program. And so you're coming out with a new book called Inflated Money, Debt, and the American Dream.
Yes.
Que paso? What's that book of? How does money and the American dream and debt fit together?
Well, in the beginning, there was only one kind of money, which was gold.
Right.
Everything else was debt. Yeah. And then this fellow named Abraham Lincoln came along, got elected president, and he had to fight the Civil War. But the problem was the government was broke. So he created the first cryptocurrency, the greenback, which was actually a piece of debt. It bore interest. It was like a T-bill. And they used that flotation of funny money to finance the Civil War. But by the time we got up into the Grant administration, that piece of paper, which had traded down to about 20 cents versus gold, actually retraced all the way back up to par because the country needed money. We had no money. The whole country was basically run on barter.
Yeah, so Grant was Ulysses S. Grant. He was a general who became president.
That's correct. That's correct. A famous president. But, it was a high growth time in the U.S. And the point of the book, Inflated, is to teach people how we got here. How did we end up as the dominant economy in the world? How did we end up with everybody using the dollar? And how did we end up with all this debt? I mean, who on earth decided to lend us all this money, right? So the book basically takes you into that. This is the second edition. The first one was published 15 years ago. And I added a new chapter. We had to talk about Ben Bernanke and Janet Yellen and Jerome Powell and all the fun and games that they've engaged in over the past decade, and then try and give people a sense of where we're going. And who's at the end of the book but Jim Rickards. And what is his message? Buy gold.
So the author of Inflated Money, Debt, and the American Dream. But my question is, because I think you and I are in the same way. I haven't read the book, obviously, I haven't got it yet. But we're on the same wavelength, because I think the American dream is disappearing. Is that what you say?
No, I think the American dream is changing. We have to deal with fact versus illusion. When you go through a period of war, first World War I and then World War II, our young country was essentially handed the baton by Great Britain as they collapsed in a heap in front of us. By World War II, Britain and most of the European powers were broke. They didn't even have the money to kill one another at that point. And the U.S. provided the guns and the butter and all the other inputs you need for global destruction. And then afterwards, we rebuilt the world.
Right.
So we went from protectionist and isolationist to free trader in a period of 15, 20 years. And that's what we've had until now. And then a fellow named Donald Trump shows up and says, well, we can't do this anymore. And I get into this in the book. There were some very smart people in the United States in the 1950s and 60s who realized that running a global reserve currency, essentially a free utility for the world to use for trade and investments, is expensive. And over time, we compounded the error with a lot of debt. If you have a fiat currency, Robert, you can't put a lot of debt on top of it because it is debt. And so we have the whole point of Inflated is to describe the layers of leverage that we have put on top of our republic over the last 100+ years. Is the American dream dead? No, but we have to shed some of the socialist, trappings and pretensions that came with the New Deal and came with the post-war period, because in our hubris, we thought we could do whatever we wanted and just borrow endless amounts of money. There's a whole branch of economics here in the United States that doesn't seem to mind debt. It thinks it's just fine. I love it when economists talk to me about continuous markets, as though they're just going to be there. But one of the things we talk about in Inflated is the Treasury market. Did the Treasury market just spring out of the ground one morning and say, here, buy some T-bills? No, it was created right after World War II. And we have done our best to destroy it. So when you talk about the American dream, how we're going to finance things in the future, these are kind of important topics. And it's a topic near and dear to our friend Jim Rickard's heart, too. I think we just have to evolve and change. That's what it comes down to. I'm actually very optimistic about the future. But we're going to have to break some eggs to get there.
Silver is the most ignored asset in the market right now, and I believe it could double this year from $35 to $70 an ounce. Why? Because silver demand is exploding. Silver powers solar panels, electric vehicles, AI, semiconductors. It's in your phone, your water, your medicine. But while demand is surging, supply is collapsing. Mines are flat, scraps drying up. Governments are even stockpiling it. Meanwhile, gold breaks records, Bitcoin soaring, but silver still stuck at half its all-time high. That's not a mistake. That's an opportunity. That's why I'm loading up. If you want to learn how to add real silver to your IRA or 401k tax-free, text SILVER to 24999. You'll get the Rich Dad Silver Forecast Guide. Again, text SILVER to 24999 before silver rockets past $70.
Hello, Robert Kiyosaki, the Rich Dad Radio Show. Today we have a very important show, but we've always had important shows. And as you know, we talk about financial education, and this is a very important aspect of financial education. So today we have Alejandro Cardona. So the reason I want Alejandro in it, when I tell Alejandro, we're over here right now, all-time market high, and we're going to crash here.
Yes.
I mean, the market's going to crash. Do you care?
No, actually, no. I did a lot of money when the market went down because
you make more money.
When the president announced the tariffs, I was ready for that. And we did 50 times our investments with options put, which gained a lot of value for that reason. And then when the market went to the bottom of the long-term trend, and we bought some calls too. So it's a very dynamic market, which is not like I'm buying and holding, because we have to take advantage of every opportunity that the market does for us. I think it's a very generous market. It's a very volatile market. And when we are trained to do certain things, it's perfect.
Hang on.
Yes,
I just want to hear that you don't care if it goes up or down.
No, I don't care.
Okay, because this is what you do. He's a technical.
Yes.
Fundamental. This is Cash Flow 101. Yes. And this is all financial education. I mean, and one last book I'm going to plug is Rich Dad's Prophecy. Came out in 2002, I think.
I read it.
And I said the stock market crash is coming. Well, it's here now. It's coming down big.
Yes.
And who that's going to wipe out are all the guys with pensions, all the baby boomers with pensions, with 401ks, IRAs, RRSPs. Their pensions are going to get destroyed when it crashes. So, Alejandro, when I tell you the market's going to crash, do you care?
No, actually not. I can make more money and faster. Yeah. Those falls recently, after the tariffs announcement, it was a lot of money there. I mean, it's like you are creating the money, and you thought through your teachings, through your books. I mean, rich people create the money. They doesn't work for money. They don't work for money. So that's true in the markets.
Yeah. So the market's up
Yeah.
here. Are you going to invest more for it to go up, or you'll be waiting for it to go here?
Yeah, to go to the bottom. But I can make
Yeah.
the puts. The puts are really cheap on those points. It's like a kind of promotion, no? It's like a discount for puts when the market goes down, and then when the market fall, I mean, you make a lot of money through those instruments. But the way that I did, dear Robert, is I started with small deals.
Yeah.
That's so deep. I didn't start
Yeah.
with big deals, buildings, apartment complexes, and all this. No, small deals, a little bit of money here, over there, so I can accumulate an initial capital to invest in big deals or cash flow deals. That's a huge
Yeah.
lesson. And through real estate, when I remember that lesson, you were, I think, in Texas or something like that with Ken McElroy, and you explained
Yeah.
how uh, increase the value of the property, adding
Yeah.
value, and then you
Right.
refinance the whole thing, and that money is free. And that was like,
Right.
oh my God, what is this?
Oh,
Yeah, it's like an explosion,
tax-free.
atomic explosion in my head.
Tax-free.
Tax-free.
Tax-free. Because it's
And
debt.
that's what I do. That's what I do. It was one lesson, and in
Yeah.
turn, it turns into a huge reality for me, doing this kind of
Yeah.
deals and using debt to leverage my money and increasing. But I mean, it's a process. The process is what makes us richer and multimillionaires, because it's been a process.
Hello, Robert Kiyosaki, Rich Dad Radio Show, broadcasting from beautiful Phoenix, Arizona. And we have a very important show with you. My guest today is Tom Wheelwright. He's been with me for 20-something years now. Tom is a CPA, but more than that, he's the author of this book here, Tax-Free Wealth. So, Tom, welcome to the Rich Dad Show.
Thanks, Robert. It's always good to be on the Rich Dad Show talking about taxes, my favorite subject.
Yeah. And then we'll bring this up. This was book number 2 of Rich Dad. It was called The Cash Flow Quadrant. And it fits right in perfectly to what my rich dad was telling me, was my best friend's father, and what Tom is saying. So let's go. So, most people say, go to school and get a job and you become an employee. So, Tom, this is worldwide. Approximately what percent in taxes do employees pay?
Yeah. If you make good salary worldwide, you're going to pay 40 to 45%, 40% in tax.
Okay, 40%. And then if you say, oh, my goodness gracious. This was the wrong way. But anyway, going this way. I don't know who drew this thing. But anyway, let's I'm going to quit my job. I'm going to start my own business. So you move into self-employed, or you become a doctor, a lawyer, or an accountant, something like this. How much do this, the biggest mistake is employees who quit their jobs to start the business. What tax bracket do they go into?
Yeah, now they go into about a 60% tax bracket.
60%. So congratulations, you started your own business, and now the government taxes you harder. And then B stands for big business, and according to the IRS codes, Internal Revenue Service Code, this is approximately 500 employees. So that's Elon Musk, Donald Trump, Jeff Bezos and those guys. So how much does a big business entrepreneur pay?
About 20%.
About 20%. And I stands for insider. It's not inside investor. See, these people invest from the outside. They invest in stocks, bonds, mutual funds, ETFs, the stuff that Tony Robbins recommends. I think it's funny. But my rich dad said, come here, be an insider in a deal. And so we don't We don't play with those stocks, bonds, mutual funds on the outside. What does an insider pay?
They can pay as little as zero.
So this was my rich dad's advice, was down here, learn to be an entrepreneur and learn how to invest. So one of the first things I had to do was take a course on real estate. I took sales from when I was getting out of the Marine Corps in 74. I took sales from Xerox because you have to learn how to sell. And then I took real estate to be an inside investor. Your comments on that, Tom?
Yeah, like I said, I mean, that's how the tax law is written. And the reason is because it's doing what the government wants you to do, right? It's just, I mean, I think that's a really good point, that the people in the E and the S quadrant, they're working for money. The people in the B and the I quadrant are working for assets. They're actually hiring employees. They're hiring people. They're building real estate. They're developing energy. They're growing crops. I mean, that's who those people are. And the government says, hey, we'll incentivize you to do that because we realize that you're taking some risk there, and we're happy to help offset that risk with lower taxes.
So these are not loopholes. These are incentives. The government's saying, look, if you hire people, we'll give you a better tax break. But if you become an employee who's hired, they tax these guys here. Is that correct?
That's exactly right.
And then they want us to use money or capital to provide more jobs for these guys up here.
That's right. It's either other people's time and talents, which is the B quadrant, or other people's capital, which is the I quadrant.
So Tom, what advice do you have for people who are in these categories? What can they do? Let's say you're an S paying the highest taxes. Is there something you can do?
Yeah, there actually are a couple of things you can do. First of all, just because you're small doesn't mean you can't act like the big guys. So you can actually if you have the right tax advisor, you can actually behave like the big guys and get the same tax result as the big guys. You don't have to pay 60%. That's actually a choice. And I think it's a choice of ignorance, because once you learn how, you can go from S to B from a tax standpoint pretty easily. And then on the I side, this is a matter of going from S to I is really the more money you make, the more assets you need to buy. That's what it comes down to. The more money you make, the more assets you need to buy.
That's what's really interesting about Tom, is because I make so much money in this category anyway. I have got to keep buying. And I generally buy oil, real estate, and cattle, livestock. So there are different categories. Even if you're up here, you can stay up here, but act more diligently down here. Any comments on that?
Yeah, for sure. You may make your money as an employee or self-employed person, and that's fine. But when you invest your money, invest it like a big business owner, invest it like an inside investor, and then you're doing what the government wants you to do with your money, and actually you'll actually end up with more assets. It's interesting. I find that by investing the way the government wants you actually make more money on your investments, not just pay less tax.
Yeah. So what I do is I just keep focusing here now. I'm at the later stage of my life. So what I have to do is I have to buy more real estate.
That's right.
But not my house. I buy rental properties from Kenny McElroy. So I get depreciation, But this other thing is, people invest in oil. I was an oil man. I went to Kings Point to drive oil tankers for Standard Oil. And people invest in oil stock. That's not the same as investing in oil like with Mike Maselli. Mike Maselli is my oil guy. And I invest directly in the oil well. What's the difference there, Tom, between stocks and investing in oil wells?
Well, you think about it. What does the government want? They want you to actually drill more oil. They want you to produce more cattle. They want you to build more real estate. And so they want you to invest in the actual hard asset. They don't want you to invest in a derivative, which would be the stock. They want you to invest in the asset itself.
Yeah. So when I meet these financial planners who say, well, invest in the S&P 500, I just go, loser, I wouldn't do that. Now, you might have to. It's better than not doing anything. But I don't want to be a loser and invest in the S&P or the Nifty. The Nifty? There was a Nifty Thrifty, and then now is the Big 8, right? The Apple, Microsoft, and all that. So I just don't touch those stocks. Any comments on that?
Well, so interestingly enough, as important as the stock market is to in the economy, it's not, from a tax standpoint, it's the hardest way to reduce your taxes. I mean, about all you can do. You can do a 401k or IRA and you get a little bit of deduction here and there, but you're not investing in the actual asset. So the government's saying, look, it's okay if you save for retirement. We're happy to help you with that. But if you're going to do more than that, if you really want to be a serious investor, we need you investing in the I quadrant, because that's where we need the production.
This podcast is a presentation of Rich Dad Media Network.